Hey everybody, and welcome back to Sip and Talk. Today, we're taking a look at a whole stack of information, really. It covers the current global economic climate, the ongoing tariff situation, which is still up in the air, and this, well, fascinating intersection of the token concept and the AI economy.
Yeah, lots to unpack there.
Definitely. Our mission, as always, is to try and sift through this, pull out the really important bits, and, help you get a clearer sense of what's actually happening and why it matters.
And speaking of what's happening right now, some of this info points to some very recent volatility.
Oh, yeah. Like what?
Well, just this June 13th, 2025, there was apparently a pretty significant geopolitical jolt coming out of the Middle East. Sounds like an exchange of strikes between Iran and Israel, maybe hitting nuclear facilities.
Wow, okay, that sounds serious. And the market reaction?
Immediate and quite telling. It really shows how interconnected and sensitive things are globally. We saw spot gold prices, for instance, spike to a new historical high almost instantly.
A flight to safety then.
Absolutely. And the VIX, the market's fear index, that saw a significant jump too.
Not surprising.
And major indices like the S&P 500, broader U.S. stocks, they dipped sharply, hit daily, weekly, even monthly lows in some cases.
It really drives home how fast risk perception can just change everything, doesn't it?
It really does.
And on top of all that, you mentioned the tariff situation, still very much unresolved. Markets are just waiting.
Pretty much, just kind of holding their breath, waiting for the next development there.
Right. And that kind of uncertainty piled onto existing worries about the economy? Well, it sounds like a challenging environment.
Definitely. For investors, for businesses, it creates a lot of headwinds.
Okay, so let's unpack that, this sort of underlying unease. Even when we see some positive headlines sometimes, why do these analyses point to persistent worries about the U.S. economy right now? What are the signals suggesting trouble beneath the surface?
Well, one major signal is coming from economic data forecasts. Some projections suggest a potential weakening ahead.
Like what specifically?
For instance, one forecast indicates U.S. unemployment might tick up, maybe even go over 4.5% in the third quarter of 2025.
Okay, and why is that potentially happening? Any specific reasons cited?
Part of the concern seems to be that the private sector, well, it isn't fully absorbing government workers who were laid off earlier. There's maybe a bit of a mismatch in the job market right now.
Okay.
And then you have consumer spending. It's held up reasonably well, but it's facing real headwinds. Things like trade policy uncertainty, that can dampen confidence, hit retail sales.
Makes sense. People get nervous, they spend less.
Exactly. And we also see caution reflected in business investment. There was a reported slowdown in structural investment, building new factories, buying major equipment late last year.
Right.
And forecasts suggested it could drop further in early 2025. That tells you businesses are hitting pause, sort of waiting to see how things shake out.
So businesses are hesitant, jobs might soften, and this isn't just a U.S. story, is it? The global picture is also looking a bit less rosy.
That's right. The IMF, for example, they lowered their global growth forecast for 2025 down to 2.9%.
Okay.
And for the U.S. specifically, growth is projected to slow quite a bit, down to maybe 1% in 2025 from 2.3% in 2024. Plus, you've got spillover effects from slowdowns in places like China and the Eurozone. It adds to this overall sense of a decelerating global engine.
Right. It's all connected. So slower growth, potential job softness, businesses pulling back.
Yeah.
How does this tie into worries about company profits? Are earnings expectations holding up?
This is where the market reaction gets really interesting. The price-to-earnings ratio for the S&P 500, basically how much investors are paying for each dollar of earnings, it was pretty high early in 2025.
Elevated, yeah.
Very. And that led a lot of people to see valuations as stretched. The potential reward maybe didn't justify the risk involved.
Like buying a stock that's already had its big run-up?
Precisely. And there was a survey mentioned that confirmed this feeling. Lots of big institutional investors, they were expecting lower U.S. stock returns in 2025 compared to that really strong average we saw over the last decade, which is 12.39%?
Quite a drop in expectations then.
Definitely. And what's also interesting is how uneven the performance is across different sectors.
Oh, yeah.
Yeah, in Q1 2025, some big growth sectors like tech and consumer discretionary, they were actually down quite a bit. IT dropped 12.7%, consumer discretionary fell 13.8%.
Wow.
But then more traditional or maybe defensive areas like energy and healthcare, they were up. Energy plus 10.2%, healthcare plus 6.5%.
So rotation happening. Money moving away from some of the previous darlings. Except maybe parts of AI.
That's the paradox, isn't it? You have these incredible earnings reports and excitement around companies like NVIDIA in the AI space. Huge strength there.
Right.
But at the same time, you hear this growing concern, this chatter about, is this an AI bubble? You know, like tech booms we've seen before that maybe didn't end so well.
Yeah, the .com comparison comes up. And how does the whole tariff situation layer onto these economic and earnings worries? Does it just amplify things?
It really does. The tariff factor just adds another layer of unpredictable costs and potential market disruption. These policies can directly bump up the cost of materials or components for businesses, right? Squeezing their profit margins.
Makes it harder to plan.
Absolutely. So you combine higher costs with maybe uncertain demand because of the broader economy or geopolitics. It gets really tough for companies to forecast their earnings accurately.
And this uncertainty, this nervousness, that's reflected in the VIX index you mentioned.
Directly. We saw that huge spike in the VIX back in April 2025, hitting 60.13, that kind of level. It doesn't just happen. It's a clear signal that the market is really sensitive to these fundamental issues, trade policy, geopolitics, the lot.
And it's not just market jitters. It impacts the real economy, too.
Seems so. Some research correlates those VIX spikes with actual drops later on in business investment and industrial production. So it's not just abstract fear. It can have real-world consequences.
Okay, so summing up that part, we've got slowing data, worries about earnings justifying high prices, plus the wild cards of tariffs and geopolitics.
Yeah.
All creating this kind of unease around the U.S. economy.
It's a good summary, yeah.
Which leads us nicely into the next big point that comes through. Given all these U.S.-centric worries, why are investors apparently looking more outside the U.S. and maybe even away from the U.S. dollar?
Well, it's a pretty logical reaction, isn't it, when you see these pressures building, those high valuations in the U.S. market, that S&P 500 PE ratio. It looks stretched, not just historically, but also when you compare it to many other markets around the world.
Right.
Some commentary is quite blunt, calling U.S. valuations absurd compared to, say, emerging markets or parts of Europe where valuations are much lower. They might offer better potential growth for the price you pay.
So it's partly just hunting for better value somewhere else.
That's a big part of it, yeah. And then there's the policy uncertainty right here in the U.S., debates over tariffs, immigration, government spending plans. It all adds to market volatility, feeds into that higher VIX.
For international investors especially, this unpredictability can make other places look, well, relatively more stable, or at least offer a different kind of risk.
Okay, what about the dollar itself? It's been pretty strong for a while. Isn't it still seen as the ultimate safe haven currency?
It did show strength in 2024, that's true, but there seems to be a growing concern about a potential long-term weakening.
Why is that?
Partly, it's linked to the U.S. national debt. It's large, it's growing, and some prominent voices are warning it's becoming unsustainable. Over time, worries about debt can definitely erode confidence in a currency.
Right, the long-term fiscal picture.
Exactly. Plus, there's a practical consideration: the costs for foreign investors to hedge against potential dollar declines. If hedging gets expensive, it just makes investing in assets denominated in other currencies relatively more attractive.
Okay, so if the U.S. market looks pricey, maybe uncertain, and there are questions about the dollar long-term, where are investors actually looking? What are the appealing alternatives? The analyses point to a few areas. European and Latin American stock markets, for instance, actually did better than the U.S. market in the first quarter of 2025.
Interesting. Why might that be?
Could be those lower starting valuations we talked about, and maybe they're benefiting from currency movements if the dollar starts to soften. We also saw some specific emerging markets showing strength, like Johannesburg mentioned, for Q3 2024. So opportunities are popping up regionally.
And it's not just other stock markets, right? Other types of assets too?
Absolutely. Non-dollar assets like gold and commodities are seen as increasingly attractive hedges in this environment. Gold was up, 19% according to one report. Commodities up 8.9%.
Yeah, those tend to do well in uncertain times.
They often do, especially with geopolitical tensions, tariff disputes maybe fueling inflation concerns or worries about currency weakness. We're also apparently seeing less appetite for U.S. government bonds from investors in Europe and Japan.
Why is that?
Reportedly because they can just get better returns on government debt closer to home right now.
Got it. So it's a mix of things driving this shift.
Yeah.
Looking for better value, better returns, and just deliberately managing risk by diversifying away from the U.S.
Exactly. That diversification piece is key. Geopolitical tensions, like the U.S.-China trade friction, specifically make some foreign investors maybe a bit wary of putting all their eggs in the U.S. basket.
Yeah, spreading the risk makes sense when your home market feels expensive and maybe unpredictable. So looking at different places, different kinds of assets, emerging market bonds, maybe inflation-protected stuff like TPS, gold.
It's all about building that diversified portfolio to navigate this uncertainty.
Okay, shifting gears pretty dramatically now. Let's move away from traditional economics and markets to something totally different. But as you said, increasingly linked, the AI economy. And specifically, this concept getting a lot of buzz, championed by folks like NVIDIA's CEO Huang Jian, the token.
Right, the token.
Now, when most people hear token, they probably think crypto, right? But that's not what this is.
No, completely different context. In the world of AI, especially generative AI, a token is basically the smallest unit of data the AI works with.
The smallest piece.
Yeah, think of it like the atom of AI computation. It could be a whole word, part of a word, maybe just a single character or punctuation. It's the fundamental building block the AI uses to understand input and generate output.
So when I type a prompt into an AI, it's breaking it down into these tokens.
Yeah.
And when it writes back, it's putting tokens together.
That's exactly it. It's the core unit.
Yeah.
And Huang sees these tokens as absolutely critical for AI's future, especially as AI gets smarter, moving beyond just generating stuff to actually reasoning, planning, performing actions autonomously.
Okay.
He's really framing tokens as the key metric for AI compute power and value, almost like the bit was for the original digital age. The token is for the AI age. It's the fundamental unit of performance.
And he talks about data centers changing too, doesn't he? Turning into something else.
Yeah, he calls them AI factories.
AI factories.
And their main job, generating tokens as fast and efficiently as possible. He even speculates that maybe future business productivity won't be measured in dollars or output, but in tokens per second.
Wow, that's a big shift in thinking. Measuring productivity by token generation.
It's a complete reframing, and it directly drives the demand for specialized hardware, right? Processing and generating all these tokens takes massive computational power.
More complex AI needs more tokens, needs more power.
Exactly. Which pushes the need for faster, more efficient AI chips. Huang gives examples of how many tokens specific chips or whole data centers can crank out per second. That raw token output directly links to how well an AI application runs and potentially how much revenue it can generate.
So this leads to the idea of in-token economics.
Yeah, that's the fascinating potential framework. This idea that token economics could shape the whole AI era. It could influence hardware design, how businesses price things. Maybe you pay per million tokens used instead of per user or per month.
Like utilities.
Kind of. And the prediction is just massive growth in demand for token processing. That becomes the fundamental driver, pushing innovation globally in computing, in energy efficiency for these factories, in network capacity to handle it all.
Okay, so the token is the basic ingredient. AI factories make them efficiently, and token economics might be the new business model. Let's zoom out again slightly and look at the broader AI industry landscape based on some other insights.
Sounds good.
The potential seems huge. Some analyses suggest the AI services market is starting from a much bigger base than previous tech shifts, like cloud computing. And the growth potential over the next, say, 10, 20 years is described as just enormous.
It really is, impacting both services and software. And a key shift people are highlighting is how successful AI companies are moving towards selling solutions or outcomes, not just tools.
What's the difference there?
Well, it means they're not just competing for a slice of the IT software budget anymore. They're competing for the budget currently spent on human labor. They're offering to automate or seriously boost tasks people do now.
Right, competing with salaries, essentially.
In a way, yeah. And what's compelling is the view that AI adoption feels almost inevitable now. The key pieces, the compute power, the networks, the data, the talent, they're all considered ready.
And things spread faster now.
Much faster. Think about it, billions of internet users, global social media. Something like ChatGPT just explodes globally almost overnight. That shows how quickly AI innovation can spread today.
So where's the real money made in this AI boom? Is it the chip makers, the infrastructure guys, or the apps people actually use?
Well, history suggests, like with past tech waves, that often the biggest value creation, the multi-billion-dollar companies, emerge in the application layer.
The AI that actually does something specific for people or businesses.
Exactly. The tools for legal research or medical diagnosis or writing code or marketing copy, whatever it might be.
So if you're building an AI startup, what's the advice?
The thinking seems to be focus. Pick specific problems in specific industries, verticals. Solve complex things that take a lot of human effort right now. And don't just offer a piece of the puzzle, offer an end-to-end solution.
Go deep, not just wide.
Precisely. And the data flywheel concept is crucial.
Explain that.
It's using the data from your product, how people use it, to constantly make the AI model better. More usage means more data, which improves the product, which attracts more users, generates more data. It's a virtuous cycle.
It's a competitive advantage.
Potentially a strong one. But critically, it needs to be tied to real business goals. And you absolutely need customer trust to get the data you need for that improvement loop. We're already seeing some early killer apps emerge, right? ChatGPT for general stuff, Harvey mentioned for legal, Open Evidence for medical.
Yeah, those names are becoming familiar. Looking ahead, though, there's this idea of the agentic economy, AI agents, acting more autonomously.
Right.
What are the big roadblocks there? What needs to happen technically?
Seems like there are 3 key technical hurdles identified. First is persistent identity.
Meaning the AI needs to remember who it is.
Yeah, and remember its past interactions, maintain a consistent state or purpose over time. Second, seamless communication protocols. We need reliable, standard ways for these AI agents to talk to each other, and to us humans, especially for complex tasks or transactions.
Like a language for AI agents.
Sort of, yeah. And third, robust security. That's huge, especially if transactions are happening between autonomous agents without direct human oversight or face-to-face checks. How do you ensure trust and prevent fraud?
Big challenges. Which brings us to maybe a fundamental point about how we need to adapt. This idea that AI, especially generative AI, brings a kind of randomness or uncertainty into things.
Exactly. It challenges the traditional business mindset that's often based on strict plans, predictable outcomes. Computers usually do exactly what you tell them, right?
Yeah, deterministically.
Yeah.
AI, not always. It can surprise you.
It can, and that challenges that purely deterministic way of thinking. The suggestion is we need to cultivate more randomness thinking.
Randomness thinking, what does that mean in practice?
Using techniques like A/B testing to experiment quickly, making decisions based on real data and outcomes as they emerge, rather than sticking rigidly to a pre-baked plan. It's a different approach to strategy and problem solving.
More iterative, more data-driven.
Yeah. And this has really wide-ranging implications for business and society. AI enables companies to potentially grow much faster with fewer people. That's the leverage effect.
Which obviously impacts jobs.
It does. While it might change or reduce some traditional roles, it's also clear that new jobs and skills related to AI are emerging, developing it, managing it, working alongside it.
So education needs to change too.
Absolutely. The focus needs to shift towards skills like adaptability, critical thinking, that randomness thinking we mentioned, cross-disciplinary abilities, being able to work effectively with AI.
And this is all happening globally, but not uniformly.
Right. AI expansion is global, but localization is a real challenge. Language nuances, cultural context, different regulations, data privacy laws, it all varies significantly from place to place.
It's fascinating, isn't it, how these seemingly separate threads, global economic jitters, tariffs, shifting investments, are happening at the same time as this fundamental technological revolution with AI and tokens.
They really are converging. You've got this traditional economic uncertainty, policy issues like debt and trade driving capital shifts globally, and right alongside it, this incredibly rapid emergence of a new economy based on AI and maybe tokens, potentially redefining productivity and value itself.
Yeah.
Different streams, but flowing into the same river, shaping the future landscape.
Wow. Yeah, it's a complex picture, but also incredibly dynamic when you lay it all out like that. We've got these traditional economic anxieties made worse by geopolitics and policy uncertainty, pushing investors to rethink strategies globally. And at the exact same time, this fundamental shift towards an AI and token-based economy is just accelerating, maybe rewriting the rules of digital value.
It really is, and it leaves us with a pretty profound thought to chew on, doesn't it?
Yeah.
As these AI agents get smarter, more autonomous, and this idea of token economics potentially takes hold, reshaping how we even measure computational value, how do the traditional economic metrics we rely on today need to change? You know, things like unemployment rates, stock PE ratios, even the strength of currencies. How relevant will they be, or how will they need to be reevaluated in this landscape?
It's a huge question.
It really makes you ask, what does value truly mean in an economy increasingly built not just on atoms and human effort, but on generated tokens and the actions of autonomous agents?
Well, that wraps up our deep dive for this time. Thanks so much for joining us. Remember to subscribe wherever you get your podcasts.